What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today I'd like to discuss something that I've been getting a lot of questions about recently from friends, family, comments on different videos. Basically, in light of everything that has been happening in the markets, with the economy, with the entire global economic situation, with inflation, asset prices being extremely volatile, what should we think about real estate? Is now a good time to buy real estate? Is now a bad time to buy real estate? Should we wait until the crash? Should we buy now in expectation of inflation? Is there a difference in looking at rental properties versus a primary residence? So in this video, I'm going to answer all those questions and tell you my thoughts on real estate. Let's dive in. All right, just so that you know where I'm coming from, I currently have about 40% of my portfolio in rental properties. Not REITs, not paper exposure to real estate, actual physical residential, not commercial, physical residential rental properties. Further than that, I also do not own the home that I actually live in myself. I rent. Now, you may be coming at your financial goals from a little bit of a different angle than what I'm approaching my financial goals from. And so we'll look at a couple different angles and how you might want to move forward, because even understanding what is probably going to happen for your individual situation, you might make a different choice. So in a quick rundown, just in case you're new to the channel, what it looks like the economy is going through and is about to face can be summed up in basically extreme inflation. Between the current monetary policy coming from the Fed and the fiscal policy coming from Congress, the president, and the Treasury, we have a coordination of slamming a ton of newly created dollars into an economy that is experiencing a massive shutdown right now, where you have a lot of the different sectors experiencing the biggest drop in demand they've ever seen. You're experiencing supply chains broken, where especially with something like food, you've got farms that are literally dumping food because the supply chain has shut down. They can't get that food to the markets, and people are then going to the grocery store and it looks like there's no supply, and so prices are going up because people are trying to get their hands on things that due to the supply chain breaking down, they haven't been able to get their hands on. Now, whenever there is a response like this, where records are being broken pretty much every single day on how bad the economic numbers are getting, from unemployment to manufacturing, and that's met with monetary expansion that is at levels never before seen, it is the perfect recipe for inflation. Big inflation. That is a statement that is backed up by literally thousands of years of documented cases across countries, across the world, across cultures, different types of government, different forms of societies. Those are the recipes you need for massive inflation. Now, when new money is printed first, it usually hits asset prices first. Due to the Cantillon effect, it goes to the people who are most creditworthy, and so they benefit. And then by the time that new money trickles throughout the society, prices have moved and everything has reached escape velocity. By the time the people, usually the poor, get their hands on that new money, everything else has already gotten more expensive than that new money that they're getting. Now, a lot of people, especially millennials, are looking at this crisis through the lens of the last crisis. And in the last crisis, housing prices, obviously everybody remembers, they skyrocketed. A lot of millennials' parents were sucked into this game of buying 2, 3, 4 rental properties with adjustable rate mortgages. And then when everything collapsed, they lost it all. And so there's a lot of young people right now that have had good jobs for the last number of years. They have a ton of money in their savings account and they're waiting for the next crash, buy a house for a really cheap price because they realize they missed the boat in 2011 and 2012. But the problem is this crisis is not going to look like the last one did. Now, the last time around, because of the housing crisis and because of how much mortgages and mortgage-backed securities had infiltrated the rest of the financial system, the entire world was saying, hey, United States, you guys need to do something about this because you're about to take us out with you. And so the United States basically said, okay, yeah, we can do something about this. We're going to have to issue a ton of new debt, a ton of new treasuries, and spend a lot of money to bail out the economy. So the rest of the world said, yeah, that's fine. We'll loan you the money, because that's what buying a treasury is. So they said, we'll buy those treasuries from you so that you can finance the bailout, so that this doesn't take us out with you. And so while the last crisis was inflationary and a lot of people's cost of living housing did end up going up a lot from it, and it was just masked through different features in the CPI. You can go back and watch my video on how we actually have a lot higher inflation than the official numbers point to. I'll link that video in the description below. But this time around, it's different because for the last couple of years, the rest of the world has kind of caught on and realized, hey, the United States of America is not treating this as if it was just an emergency one-time thing. They've been expanding the balance sheet and expanding the debt and expanding the deficits ever since the crisis. And as soon as we tried to reverse course, you remember back in 2018, the markets started to crater. Because if you swallow a financial bomb and then try to unload it back out onto the economy, it's going to start to break things. And so the Fed had to reverse course, start dropping interest rates again, and the rest of the world realized, hey, this is the plan. It is going to be QE in perpetuity. They're never going to wind down that balance sheet. This inflationary policy is going to persist and grow. The US can't actually get out of this trap that they've set for themselves. And so central banks around the world have been net sellers of treasuries for the last couple of years for the first time in decades. And so this crisis, this time around, they're not doing the same thing that they did last time, which was buying our debt, which was loaning money to us. They're actually selling the US debt that they already have. And that's why the Federal Reserve has opened up so many new facilities and programs in order to buy treasuries from the rest of the world in exchange for dollars, in order to help the world unload their treasuries without tanking the value of treasuries, which would spike the interest rates and cause the US government to default on its debt. So what this means is that the Federal Reserve is now the only one who's funding this United States government debt. And so the spending is directly coming from new money being printed. And so if you've wondered why we've had such a sharp increase in stock market prices recently, it's because of all of the new money, the insane amounts, the trillions of dollars that have been pumped into the economy. New money always goes into assets first. So what does that have to do with real estate? Well, that means real estate is not going to have the same effect that it had last time. Now, we also have to look at the fact that this is also a public health crisis. There's a pandemic. The coronavirus has a big impact on this. People are not moving right now. Nobody's accepting people into their homes. Nobody's showing their homes and hoping everybody else wears masks and nobody else is sick. People are on lockdown. Foreclosures are not happening. Evictions are not happening by law. Even people that aren't paying the rent and aren't paying their mortgages because of mortgage forbearance, nobody's moving right now. So that's keeping home prices pretty steady where they're at right now, number one. Number two, commercial real estate, as a unique symptom or a unique consequence of this pandemic, commercial real estate is getting absolutely slaughtered. Restaurants all over the nation are closing down for good. They're not able to get their hands on the stimulus money fast enough, and they're literally closing down for good forever. Number two, retail is also getting absolutely clobbered. There are stores and chains, whether it's mom and pop or huge, all over the nation that are not being able to pay their mortgages, not being able to pay their leases. Companies that were already doing pretty bad because of e-commerce and because of people shopping online, this crisis has only accelerated that. And so there's a massive hit to commercial real estate from those two things. And then the third thing hitting commercial real estate is work from home. There are hundreds and thousands of businesses right now that are saying, hey, work from home works. Our employees are happier. If we continue to do this, it's actually a lot cheaper to pay for somebody's laptop and their internet connection and a couple other things. It's a lot cheaper than paying for buildings where we do all that stuff ourselves. Our employees are happier because they have more freedom. They're graded on the actual work that they do rather than being micromanaged and getting their time sucked from these meetings. They don't have to spend so much time commuting. And so there are hundreds and thousands of companies that are realizing we're just going to do this forever. We're not going to go back to the office. We're going to implement work from home for good. And at the very least, implementing work from home partially for their employees and then staggering shifts in shared workspaces and cutting down on the amount of commercial real estate that they're having to pay for. And so on three fronts, this crisis is absolutely demolishing commercial real estate. On the bright side, though, that means that the demand for residential real estate will at least stay the same and potentially even go up, because as more and more middle-class workers are going to be working from home, you're going to need more and more workspace at home. And so there will be upgrading being done in order to buy houses with more rooms to turn into home offices. As the crisis unfolds and the economic conditions deteriorate, you're going to have continued demand for the low income housing, as well as people have to downgrade in order to find places that they can afford, or you're going to have people move in together into the larger properties. And in many cities and in many states, there's already a huge shortage of affordable housing, and that's not likely to change anytime soon, just due to basically zoning laws that prevent builders from profitably building affordable low-income housing. Further than that, as the rest of the world is dumping their treasuries, they're receiving dollars for those treasuries. And a treasury is basically a dollar that pays interest. And if you don't want a dollar that pays interest, you definitely don't want a regular dollar that doesn't pay interest. So you're going to get rid of those. But as the rest of the world is getting rid of dollars, they're not going to be able to send those dollars to China or Malaysia or the UK or Turkey or anywhere else around the world that is also dumping their dollars. The only destination, the final destination for those dollars is going to be the United States of America. And the first thing that's going to hit is assets. Yeah, you could trade your dollar for a hammer, just like we buy cheap products from China and India right now. That situation is going to reverse itself. They're going to be dumping their dollars for relatively cheap products that are held in America. But before you resort to buying cheap products, you're going to try and buy assets that will hold their value, produce income. And so all those dollars around the world are going to be flooding back in, and they're hitting asset prices. And in inflationary environments, real assets are prioritized. Physical assets are prioritized more than paper assets. And again, this didn't happen during the last crisis. This is something unique to this one, where all these dollars are going to be coming back home, and it looks like they're going to be hitting real estate. And as commercial real estate is getting hammered, and it doesn't look like that trend is reversing anytime soon, there could potentially be a priority placed from foreign dollars on owning residential real estate. So what does that mean in practice? It means that my outlook, it looks like commercial real estate is going to continue to do relatively poorly for a while. So I'm not buying commercial real estate right now. What I do have is residential rental properties, and I'm not selling that right now because in terms of inflation, as the dollar crashes and as foreign-owned dollars rush in to buy up U.S. real assets, it looks like that will at least keep the value of real estate and probably most likely make that price go up, in addition to the fact that the demand for residential real estate is only getting stronger right now, even in the midst of this crisis. And so buying a rental property that you can rent out that will produce cash flow for you that is in excess of all of your expenses, the debt service, the interest, the principal, the maintenance, and vacancy, you're going to pretty much lock in what those expenses are, because the majority of those are going to be from a fixed rate mortgage, and that's not going to change. That mortgage, let's say it's 4 or even 5%, there's no way in the coming years inflation is going to stay under that amount. And so you're essentially, in real terms, not in nominal terms, but in real terms, you're locking in free money, an interest-free or a negative interest loan, when you're talking in real terms, not in nominal terms, because the value that the dollars are losing is more than what you're paying in interest. And so as you pay those mortgage payments, you're paying them back. Even when you account for the interest that you pay, you're paying it back with dollars that are worth less in purchasing power than what you originally borrowed. And as inflation continues to grow and the dollar continues to fall in value, that means rent prices are going to go up, just like bread prices are going to go up, just like stock prices will go up in terms of dollars, and just like the prices of everything that is measured in dollars will go up. And so your mortgage amount will stay the same, but your rent payments will be able to go up. You'll be able to hike that rent year after year. And so whether it's single family or multifamily, residential rental properties look like a fantastic opportunity right now, considering the current economic environment. What about a primary residence? Because I told you that I do not own where I live. I rent where I live. Now, some of that has been due to just personal choices with me and my family, just wanting the freedom to be able to move without have to worry about selling a property. And so there is a higher cost associated with that. I recognize that. But the majority of that decision has actually been financial, because you're not getting paid to own where you live. You're paying for that. Even if you own it outright, you're still paying your property taxes and your maintenance and your utilities, and so where you live is going to cost you money. And so whenever I've accumulated a large enough amount of money in order to deploy that into a personal residence, if I wanted to buy a place to live, every single time I've chosen to instead deploy it into something that's going to make me more money than the potential appreciation on somewhere that I'm living in. Because even when you put it in terms of gold instead of dollars, real estate will appreciate in terms of dollars, but it's very likely that real estate will depreciate in terms of gold. Now, if you're basically not a full-time investor and you don't basically just invest for a living, and your investment portfolio consists of your 401k at work, and you have a little bit that you're putting into savings every month, and now you're trying to decide whether you should buy a place or continue to rent, it would probably make sense for you to buy a place instead of continuing to rent. Because like I mentioned earlier, rent payments are going to continue to go up because of inflation. And so locking in a mortgage, especially for a personal residence, you can lock in a really low mortgage right now as rates are the lowest they've ever been. And in 10, 15, 20, 25 years, that mortgage payment is going to look extremely small compared to your cost of living when measured in dollars, because you're borrowing money with today's purchasing power and you're paying it back over time as the purchasing power of those dollars loses its value. And in all likelihood, looking forward, the price of houses measured in dollars is going to go up. So that is my current outlook on real estate. I do think the price levels measured in dollars of residential real estate will at least stay similar to what they are on average across the states, and most likely will continue to rise as foreign owned dollars pour in from countries around the world and buy up US assets. I don't think commercial real estate is something that will do well for the foreseeable future, and so right now I'm focusing on residential real estate. And if you've got a good job, good savings, and your only investing is basically through your 401k at work, and you're trying to decide whether to rent or buy right now, it probably makes a lot of sense for you to buy right now, because you'll be taking advantage of inflation, locking in a fixed rate mortgage and paying those dollars back with cheaper dollars over time, and eventually you'll own something that you could turn into an income producing asset down the road. Hope this video helps. Let me know if you have any questions or thoughts in the comments below. Hit that like and subscribe button. Really appreciate you guys. Have a great day.